Hey, this is Chris from Stockspot, and in this video I'm going to be talking about what you can do with falling interest rates. Now actually over the last few years, since about 2021 in Australia, savers have got something they hadn't for a while, which is a decent interest rate, and interest rates have been rising generally, and savings in Australia have really rocketed since the COVID crisis. So since 2020, the amount of savings that people have tucked away has increased by over 30%. So there's a ton of money sitting on the sidelines now capturing these great interest rates, which is fantastic. However, over the last few months, we've started to see the next trend emerge, which is falling interest rates in Australia. The RBA has already cut, and we're expecting to see at least 2, but potentially even 3 or 4 more interest rate cuts in Australia between now and the end of the year, which means that by the start of 2026, we'll be looking down the barrel of much lower interest rates in Australia. So I want to share 3 things I think savers can be doing to make the most of their money in a falling interest rate environment. The first tip is using this window of lower interest rates to actually build up more of a savings buffer. So for all of our clients at Stockspot, we recommend somewhere between 3 and 6 months worth of savings set aside for emergencies, health emergencies or other issues you might have. Falling interest rates may give you an opportunity to actually bank more of these savings because you won't have to put them towards your mortgage. And so a great time to be building up your savings buffer within a family, or even if you're an individual, is when interest rates are falling, and they may not fall forever. So it's a window that may not be open for a long time, and I'd be encouraging people, if you are feeling the pinch, to be working out how you can save a little bit extra and put it aside when interest rates are low. The second tip is, and this is for a group of people who have built up some more savings in their offset accounts or mortgage redraw accounts, is lower interest rates may be a good time to consider whether you should be investing some of that money. Now I've done some separate videos on this, which I'll share links to in the comments section, and there are different things to consider if you're looking at taking money out of your mortgage to invest it, but certainly it's a more attractive proposition when interest rates are lower, because the difference in the return you could be earning from a diversified portfolio versus the cost of that money, which is your mortgage rate, will be increasing, and so potentially there's a bigger benefit from investing that money. And certainly we see when interest rates are lower, a lot more interest from our clients in actually spreading their wealth into diversified portfolios from their mortgage offset accounts.
Sorry for interrupting, but I'd like to take a moment to talk about my channel. Now, most people who watch my videos don't subscribe to my channel, which means that they don't find out about other videos I'm making, and it doesn't share the love with others who are interested in investing. So if you are interested in videos like this, I would encourage you to please subscribe to my channel so you find out more about the videos we're making here.
The final tip I'd have is just be a bit cautious when interest rates are lower about not getting tricked into chasing high yield, high risk investments, because there is a temptation when interest rates are lower to scramble to earn more yield, particularly if you've had higher dividends in the past. And if you've got your mind set on a certain dividend amount, let's say it's 6% per annum, that might be easy to achieve when interest rates are 4%, but when they're 3%, it may be more difficult to achieve without taking substantially more risk. And so my tip would be, don't go and take more risk just to earn the same return. Really consider whether you could earn a lower return and potentially take some capital out as well, but be very wary about high risk, high return investments that are pitching themselves in a low interest rate environment, because while they may sound good today, if you are earning that higher return, you are always exposed to higher risks, and that's something that I think people aren't so aware of when interest rates are falling. So finally, I would say that a lower interest rate environment is a good environment to be investing. Over the long run, a diversified portfolio, you would expect, and it has historically earned a higher rate of return than money in the bank, and that's certainly more obvious when interest rates are lower. But as always, it's important to have a long-term time horizon, because markets can go up and down in the short term, and be conscious that even though the share market has done well over the very long term, there may be periods of even 6 or 12 months or even longer sometimes where your share market investment may do worse than cash in the bank, and that's okay. That's exactly what share markets do. They have periods of going up fast, then they go sideways for a while, then they come down. It's all about your long-term return, so you need to be able to stay with it, stick to your strategy, and keep investing regardless of what markets present in the short term.